What a wild week for mortgage interest rates. This week, in my opinion, changed everybody's forecast for mortgage rates in 2025. If you go back to articles that are even a week old, I think a lot of these mortgage rate forecasts for 2025 are going to change. This week specifically, December 16th to December 20th, we had inflation numbers higher than expected. We had the Fed meeting where they cut the Fed funds rate by 25 basis points, but because of what Jerome Powell said about their future plans, them revising to looking like only two rate cuts in 2025, along with the change in the dot plot, along with a lot of, talk about inflation returning in 2025. I think that's what's really keeping the lid on them being able to cut more aggressively, and it's having an effect on mortgage interest rates. So let me go through, because these ones aren't that old. These ones are relatively recent, like Redfin and Fannie Mae and National Association of Realtors, all their predictions for a range of rates for 2025, and not just a range of rates, but also the average rate for the year. I'll start with Redfin. Redfin's range is anywhere from 6.2% to 7.2%, with an average of 6.8%. What I want to remind people is when you talk about the 30-year fixed rate conventional mortgage and people are talking about an average, usually whoever's taking account of that average, that number is still kind of like best case scenario. That number is still somebody with a 760 credit score, somebody with 25% down, and possibly paying a point or so in origination. And so if you have a higher interest rate, don't feel bad. I think that, sometimes these numbers are published and someone's like, what the heck's going on? They have a 685, they're putting 3% down, and they're looking at rates that are slightly higher, and they're wondering what's wrong. So anyhow, with that to preface it, these numbers are not only going to change for the worse, but I also think individual scenarios have to account for maybe 25 or 50 basis points in a higher rate anyway. All right, Housing Wire has a big wide range. They asked for forgiveness for that big wide range of 5.75 to 7.25, but they just reminded everybody that there's volatility in the market, right? And the range can be wider than some people think, even that wide, 1.5% spread, with the average being 6.6%. I'm not going to read everybody's stuff, but you get the pick. A lot of people are in the same ranges, 6.2 to 6.7 for Fannie Mae with an average of 6.45. National Association of Realtors, theirs is lower. Theirs is 5.75 to 6.25 with 6% being kind of the average. And national, that's the lowest one, is a 6% average, which I think is probably a little bit too optimistic. I think that mid sixes, like the Redfins and the Housing Wires, who are on the other end of the spectrum, is probably more accurate. And given all the news we got this week, new presidential administration coming in next year, a lot of things pointing towards inflation's, one, not at the target that the Fed set, and two, has more headwinds than tailwinds as far as getting it down to that 2% target, right? There's a lot of stuff that people deem as inflationary coming in 2025. So with all of that out of the way, where you can just probably expect the 30-year fixed rate mortgage to be between 6.5% and 7.5% for the foreseeable future. That's what I'll give people. With all that out of the way, what does this do to the housing market? How does it affect you? That's the more important part, right? Rate matters a lot less to people who understand that they've got no control over that, and they go out and they buy investment properties only, or in spite of the higher rate. They go out and they find great deals that work at the 7.25, 7.75, 8.25, 9%. I know investors that use creative types of finance that's more expensive, but they don't care. They're getting an 18, 20, 25% return because of the deal they got on a property, because of how the property performs. The cost of capital could be 8, 9, 10%, and it doesn't matter to them. And so in 2025, the market's going to look a lot like the Q4 2024 market. And the longer that rates stay higher, the longer we stay in a market that's similar to that. And what is that? That is, buyers have more leverage, and sellers, eventually over time are going to start to learn, if I go out there and I list this property, I've got to think about what the average buyer's payment is going to be. Just because something sold in this neighborhood for 600,000, or my home is 400 square feet bigger than something that sold for 560, doesn't mean that this specific market I'm going to be able to get 600,000, because an average buyer that comes along with 5% down is going to have a mortgage payment that might be $5,000 a month, including taxes and insurance and mortgage insurance and all the things, right? And so a lot of great deals to be had. There's probably no event that creates a lot of inventory, so we're still going to operate in this weird environment of buyers have leverage because of higher interest rates and affordability issues. There's not as many buyers, but they don't have a ton of stuff to choose from. So there's not a lot of price softening. There might be a little bit. And while we're on record, I don't care to take a guess and see what happens. I think a relatively flat housing market in terms of price appreciation is the most reasonable expectation for 2025. If you told me we were going to see 5 or 10% softening and prices coming down, that wouldn't surprise me a ton. If you told me that we're going to have a 5 or 10% home price appreciation, first off, I think it's less likely that they go up, facing these higher rates and affordability issues. But it wouldn't be that surprising. And you have to remember that real estate's local. So I might say, like, that would surprise me if I saw a 10% appreciation. It's not going to surprise me to see it in different markets. This specific market, 10% appreciation. This one, other ones down by 5 or 10%. So probably within that range. If you look at the United States as a whole, some stuff's going to be single digits appreciation and gone up in value. Some's going to be single digits depreciation, and most are going to fall within that between 10% appreciation and 10% depreciation bucket. If mortgage rates continue to stay high, if there's some wild event, recession or something, with, who knows, foreign relations, we could see mortgage rates go down. But with nothing else happening and just continuing to rely on the data like the Fed's been doing, we're going to have mortgage rates much higher for much longer than people anticipated. So get your eyeglasses, your spectacles on, continue to hunt deals. There's going to be great deals to be had in 2025 and beyond. Mortgage rates, they're going to have a 6 or a 7 handle for the foreseeable future. We'll call it that. Thanks for watching. If you want to connect me and my team, go to greatmortgagebroker.com. Talk to you soon. Bye-bye.